Yeah, so thank you all for joining me. As Chris said, to look at cash flows, financial management, and the importance of it. Chris was obviously talking there about the importance of tracking your cash flows from an investment perspective. But I'm here also to help, hopefully, demonstrate why it's important to have it all throughout your business in terms of keeping track of how things are going on a week by week, month by month basis. And so just as a quick introduction to me, if this will advance, what we're going to go through today is we're going to have a little introduction section. I'll just introduce myself in a bit more detail, and then it would be handy for myself just to hear a little bit from each of you in terms of obviously what you are doing and how financially aware you think you're at, whereabouts you are in your development and sort of monitoring your financial performance, and any areas in particular where you think you might need some assistance, because that will help me frame my answers if and when you have questions throughout this seminar. And I'm happy to take questions at any point. So if we come to a point in the slides where you think you have a question or you want to know a little bit more, then please feel free to just obviously raise your hand and we'll take those questions. And we can have a more in-depth Q&A at the end as well if there's things that develop. So after the introductions, we're going to talk about why cash flow statements are important. We'll look at how the cash flow interacts with other primary financial statements that are part of the full model, that kind of cash flow aspect, looking at the implications of what changes in cash might have on the balance sheet and profit and loss account. We'll talk about how to look and forecast revenues. Additionally, the assumptions and narratives around cash flow forecasts and in particular, assumptions and narratives are really crucial to what the cash flow will say, how those assumptions have been how they've arose, and how important they are to the reliability and the understanding of the model behind it, to make sure that they're based on facts and evidence that you've got, because that will give confidence to investors or anyone that views the cash flow that it's been built solidly and it's reliable and it accurately reflects what the future might look like for the business. And then at the end, we'll look at the scenarios and risks. So as I said, if we could just do a little introduction, I'll start with myself. So I am Hugh Yardley. I'm a manager at BDO. I've been in practice for just short of 25 years now. In that time, I've been in various parts of the business. I started out in audit, as a lot of us do. I've been part of our business recovery team, so I've actually helped in running and managing businesses that have gone into receivership or liquidation, and I've understood obviously the importance from that in terms of how cash flows are important for these businesses who are looking to recover. And then, as I am just now, I'm part of our business services and outsourcing team, so that covers a lot of compliance work for businesses, but where the real key point for that service line for me is the business advisory, and that's where we engage with our clients to look at how they're performing, what they could be doing better, what they want to do, and how we go about helping them achieve their targets, their goals, their objectives, what they're looking to accomplish in the near to medium and then long-term future. So it covers a whole range, and as I said, that's where I get real drive each day to get up and help my clients achieve their goals. So as I mentioned, it would be good to just quickly learn a little bit about each of you. and just understand where you are in your cycle in terms of understanding the finances and cash flow. So I'm just gonna kind of work my way around my screen as I see it. Kathy, you're first.
Hi, nice to meet you, Hugh.
Hi there.
So my name's Kathy Sexton. I'm the director at Fathers Network Scotland. Oh, sorry,
you're a little quiet.
Is that better? Is that
That's
better?
Much better.
I'm Kathy Sexton. I'm the director at Fathers Network Scotland, which is a charity which is predominantly based in Edinburgh, but we operate across Scotland. So I suppose because we're a charity, we have to be pretty transparent about all of our financial activities.
Absolutely.
And we have fairly robust systems in place. But the challenge with charities is that you tend to be on funding cycles, and there's a lot of uncertainty around funding and when it comes in, and so cash flow is an issue.
Yeah.
As is, I would say there's always this tension between, I suppose, maintaining enough money within the organisation and not having too much. So there's always an issue around, how do you attract funding from grant givers if you have a lot of money sitting around. So that's always a tension and a difficulty, I would say, for probably all third sector organisations. And I guess the reason that I'm here and on this course is to try and provide some more stability long term for the organisation by developing different income streams. So yeah, it's very much at the heart of what we're trying to do at the moment as we transition.
Thank you very much. That was really helpful. Hal, you could go next, please.
Hello, good morning. Can you hear me
morning.
clearly?
Yes.
Excellent. I am from the Granton project, which is essentially a sort of a rebirthing of a business that I founded called The Pit, which is predominantly a street food market. And we're moving to the heart of the Granton Regeneration Project in north of Edinburgh. And we're going to be a sort of grassroots food, drink and music venue with a strong focus on sort of entrepreneurship and community. Because I've been operating The Pit, which is a sort of much smaller market since 2015. So we sort of know our numbers and we sort of know how we're how things should work. And because as we're now sort of rebirthing ourselves from scratch, essentially, we can put in some new measures. And we've also recruited a CFO, and we've got quite a good board with 5 of us on it with different experience and stuff. So we feel pretty good about it, about this side of things, and we sort of we know it. So
excellent.
It's just exciting, and just more information the better.
Brilliant. Gordon.
Hi, Hugh. Well, I'm Gordon, and I'm one of the directors of Clydecare. Well, our objective is to help people out of poverty, and we do this by offering our property services to commercial clients, and the profit gains help us meet our goals. With regards to cash flow, I do feel I'm on top of it. I do use the Xero system, but also like keeping a monthly spreadsheet. I can keep that on a weekly. I keep an eye on it on a weekly basis to see the funds coming in, and I compare it to the month before. And what I do is I keep an eye on the major outgoings, which would be the van, the running costs, and the fuel, that kind of thing. Anything else above that, I go and I usually maybe take a quarterly viewing of through Xero just to see where we are. But we're quite big on the cash flow. We've got targets, we've got goals, and we need the funds in the bank for that. So I think we're on top of it, but any other advice would be appreciated.
Excellent, thank you. And Lorna, please.
Hi, I don't know if you guys can see me or not.
Yeah.
Yeah, oh good. I can't see myself, which is a good thing. I'm Lorna. I'm the manager of Neudart Forest Trust. We're a charity who we use the woodland as a resource to achieve kind of habitat restoration and community regeneration. We also have a trading subsidiary, which is a KIC. Neudart Forest Trust's been running for 24 years, so we're quite well established, and we're just looking at how we can increase our impact. I would say in terms of financial management, we've got good systems in place. What we're probably not so good at is the cash flow forecasting, and that's, I suppose, partly because of the nature of our work. Is a lot of the kind of pure forestry based stuff is grant dependent, and when the Scottish Forestry or the Scottish Government pay the grants is very, you just never know when it's going to come in. So we
Understand.
But we do have a system in place. You know, we've got a cushion, a kind of, we know how. Yeah, I suppose what I'm saying is we know because we've been doing it so long, but I think what we should be doing is having better systems in place to outwardly demonstrate that kind of cash flow situation. So yeah, I'm very keen to learn everything you've got to say.
Excellent, thank you. And is that us all, or is there someone missing? I think that's us all here, isn't it? Yeah. Okay, great. So I'll just get stuck into the presentation. And as I said, please feel free to raise your hand and ask questions at any point in time. So simply put, what is a cash flow? You know, cash flow is looking forward at all your revenues and costs that you're going to generate and spend over a period of time. That could be as much as looking at just the near future in the next month. I can obviously be looking forward at quarterly or a 13-week period cycle, and then looking forward beyond that into what's the next year going to look like, what's the next 2 to 3 years going to look like. Having a cash flow for all of those periods as we go through it, you'll find out it's going to be really important to you, both in terms of understanding what you've got to look out for in the extreme near future, and then looking forward in terms of what's the business looking like, are we meeting our goals, our targets and objectives in terms of being responsible and managing our cash properly, but also making sure as you're meeting your targets. Obviously there's a heavy sort of charity based between the 3 years here, so as Kathy was mentioning, actually holding on to too much cash is not a good thing, because it doesn't look like you're then spending money in line with the objectives and goals of the charity. So you've got to, in some cases, have that nice balance between them. I do report to a board on a charity. I take part in their quarterly board meetings, so I help this charity on that aspect as well, making sure that they're keeping track of their cash and also spending it to make sure that they're obviously meeting the objectives set forth. So I will just move forward. So why are cash flows important? So we're going to start with, there's a couple of just little sayings here, and I'll explain why. So there's the first one that says there's profit is vanity, cash is sanity. And the reason for that is cash is something that every business needs, and they need it to obviously make sure that they're able to cover their upcoming fixed costs and those expenditures that will happen. You know, without cash or some form of funding, you'll struggle to obviously run the business. Whereas profitability, well, it might look great on paper, and it can do, it doesn't necessarily mean that you're in a good position, because you might be showing good profits, but in terms of day-to-day cash flow and management, the business might be really struggling. Hi, Jenna. Thanks for joining us. Hiya. We've only just started, so you haven't missed too much.
Thank you.
That's no problem. And going on to that, yeah, like cash is king. As I said, the only way you can make decisions on how you go forward is with cash available. You know, you've got to have cash in your bank so that you can look ahead in terms of what we're going to spend, what we're going to do, and how we go about managing the day-to-day, and then going forward month to month, quarter to quarter, to make sure that the business is robust and sustainable for the future. And in terms of cash flow statements, looking ahead to that future, it's important to plot what you think that's going to look like. So in terms of looking forward, what is our growth looking like? Do we have set targets set out and budgets in terms of what we want to achieve, what that's going to look like, and how do we get there? It's also important to plot capital spend that you've got in terms of new developments that might take place, understanding when projects like that can start, at what point you've got to be, you know, have the cash available to pay for that spend, and obviously any finance that if that capital is dependent on finance, what are the costs associated with that? When do you have to pay them? And do you have the appropriate cover in place should that finance have any covenants attached to them, to make sure that you're keeping track of how the business is performing to those covenants to be compliant with any potential lending that you get. It's also important to model any new projects that might develop. So if you've got new ideas in hand, actually plotting out, what does that look like? How much are we going to be spending there? Do you have the headroom to cover that? Will there be any pinch points that arrive, to make sure that if it does, do you have scope or sources of funding that will help you to, you know, to get through those difficult points? And the last point I've got there is obviously recruitment. Depending on your circumstances, you might be looking to acquire new hires, bring in people with new skills and experience that you don't have. Have you plotted those out in terms of, you know, the ongoing costs, both from direct, you know, the direct remuneration to any benefits, and obviously employment taxes associated with that. And at the bottom there, we've got budgeting. Budgets and cash flows quite often go hand in hand, and a lot of people kind of use them almost in the same method and as the same mechanism, because quite often budgeting can look very much, a budget can look very much like a cash flow. They are different though. You know, a budget should be looking at what different areas of the business in terms of what their allocated spend is and any revenues associated with that, and obviously monitoring against performance. And depending on how that's set up, it could be looking at it on an annual basis or monthly, but a cash flow should be focusing a bit more on when the cash is actually hitting, and the impact of that on your cash flow reserves. So they can be similar, but they're also different and important to understand it. But it's important when you're looking at your budgets at the start of any period is to plot the cash flow, look forward and see what the near future is going to look like. I'll move on to the next slide, hopefully. So, who is interested in cash flows? The short answer is everyone who has any kind of interest in your business or entity. But if we look at some of the kind of key stakeholders, so you've got the board. The board are absolutely interested in the cash flow statement, because it will demonstrate that those, you know, managing and running the day-to-day have a key understanding of what the future is looking like, and do they have, you know, sufficient reserves to make sure that the business can carry on for the near future. Certainly for those of you from a charity or not-for-profit background, more often than not, a lot of the board sit out with the day-to-day running of the entity, so they will be looking at the financials given to them, and in particular the forecast, to make sure that everything is running properly. There's future reserves to cover situations that may arise in the future, but also that there's, you know, the cash flow has got a good level of reserves and runoff period, just in case things were ever to go a bit wrong. Obviously, if you're a charity or not for profit, you know, you're used to reporting under charities SORP or SCIO in here in Scotland, so they, you know, advise that as a minimum, normally you have about 3 to 6 months of reserves in the bank to cover periods where you might not achieve funding as you'd originally forecasted or projected. So the cash flow is a key document to the board, and it will help them govern and make sure that the business is running properly. Cash flows are also really important for budget holders. Obviously, if there's within your organization, if you've got different people who are responsible for different parts of the business and have their own budget, it is key for them to track that. You know, they might have a certain allocated amount of spend in their area, and they should be monitoring. They should have their own little cash flow showing how much they need, when it's going to be spent, and obviously tracking against variance. It's key for them to be able to monitor that and then report upwards as well on a regular basis, to ensure that if there's areas where they think they're going to overspend, that it's, you know, reported, to explain why, but also to justify why that overspend is necessary. Is there a reason for it? Can it be mitigated? Do they need to be allocated additional funding to meet that, or have they been able to make savings in other areas in order to spend on a specific cost? Then we've got your bank or your bankers. So we're keeping a cash flow up to date all the time is really useful, as if you do run into a pinch point and suddenly you need to go to your bank and ask for some short-term support in particular. What will give the bank great confidence if they're looking to arrange any kind of, you know, short-term overdraft facility or other borrowing, is making sure that they can see how you're going to come out of it. You know, what does the future look like? How are you going to demonstrate to them that any facility that you do need from them, they will be able to look at, obviously, your financials with confidence and go, okay, they understand that they're going to have a dip, and if we obviously provide them with the support during that little period, we can see them coming out of it and it'll all be fine. It gives them confidence, it allays their risk and fears, and will allow them to provide a more responsive answer. If you don't have cash flows at the point, if you're going to talk to your bank, then there'll be a delay in terms of getting all that information together, and then for them to go through their processes to award any short-term support. And then as for these all, obviously these are all in looking ahead to the future and looking at, you know, investment from lenders. Then having your cash flows looking forward will be really crucial to them, because again, they've got to justify that any money they give you is in good hands, that you're going to obviously invest it appropriately and make sure that it achieves, that money's going to be well spent and achieve obviously the goals that the investment is being awarded. Your accountants, absolutely. I've got my own client portfolio, and I do stress to them how important it is to keep cash flows and look forward. I wish I could say that more of them pay attention to my advice than what they do, and actually regularly monitor their cash flow. A lot of them, some of them are just in a lucky position where they've got lots of cash, but others who do have difficulties from time to time, they're being very, very reactionary in their business decisions based on what needs paid now, rather than actually looking at, well, is this a regular occurrence? Why are we getting into this? What can we do different? And ultimately, if you're monitoring and tracking your cash flow and looking ahead, making sure you're covering all your fixed and variable costs, you start to understand why they're getting into difficulties. And that's where your accountant can be, provide real value in terms of helping you understand, what does that look like? What can be done differently? Do we have to look at negotiating with your suppliers, change credit terms, or actually is there other methods of getting out of it? And lastly, and there will be others, but creditors certainly will be very interested in a cash flow statement if it's obviously something that's publicly available. And for those who fall into the audit threshold, which obviously a lot of charities and organisations do, it obviously becomes public information once a year, but it helps to give them confidence in terms of, are you good to work with? Are you going to pay your debts? And also, if they can see that you've got good cash flow management, then they can obviously award often better credit terms, which is obviously really good for a business and an organisation to hang on to their cash a bit longer, so that they can look at making sure that the monies coming into the organisation are generally ahead of when you have to pay your bills. Does anyone have any questions yet? Okay, great. So I'm just going to double check. So how does the cash flow interact with other statements? So what's often spoke about is your effectively your three-way forecast, and that's made up of three primary financial statements: your profit and loss account, or your statement of comprehensive income, depending on your reporting, statement of financial position, otherwise what used to be known as the balance sheet, and the cash flow statement. So these three statements interact with each other throughout, and it's important to model it looking forward. So as an example, obviously the profit and loss account will often look very different to the cash flow, and that's because income and expenditure needs to be recognized at the point of when, normally, if you're in receipt of a service, or you've received goods, or you've got any costs that you've taken, you've got the risk associated with it. If that's been passed over to you, then from a profit and loss perspective, that's something you need to recognize in the period that it relates to. But from a cash flow perspective, you might not pay for that for 30 days or 60 days. So actually, it may fall into one period, or it may fall into the next reporting period. They can look very different. And as I said earlier, in terms of profit is vanity and cash is sanity, they just, a good healthy profit line, or you know, net income earned doesn't necessarily mean that you're in a healthy cash flow position, because you might have a lot of that cash tied up in things like stock that's potentially sitting on your balance sheet, or if anyone owes you money, they haven't paid their debts for obviously the service you provided, or you haven't received that grant funding yet. You know, you may have a right to it, but if you haven't received the funding, then the profit and loss in cash flow can look very different. And then you've got the balance sheet, and that is effectively kind of the outcome of what the P&L and the cash flow is going to look like. Obviously, it's a statement showing, you know, the assets, the liabilities, and the reserves of your organization. So, as I said, what might look good on paper from a profit and loss perspective, you might see that those actually where you've potentially spent money is all being tied up within the balance sheet. So you might not have cash on hand because it's all been stuck into stock that you've purchased, or as I said, you might not have just received funding, that, you know, the amounts that you're due for the services that you've provided. And obviously the other part of your balance sheet is equity, any investments that have came into the entity in order to help it grow. Okay, so I'm just gonna move forward again, and we'll just take a little bit of a look at some of the interactions. Now, based on what you've told me, some of this might be quite obvious now, but I'm just going to run through just a small worked example to demonstrate why what can happen in the profit and loss account is very different to cash flow. So if you look at the start there, what we've got is a company's bought something for £100 plus VAT on 30 days credit. So from a double entry bookkeeping perspective, what is happening there is you've purchased £100 of stock, VAT accountable to be recovered in the future from that is the £20, the 20% of it, and then the accounts payable, what you owe for those goods, is the gross amount of £120. So all we've got here at the moment is all a balance sheet entry in effect. You then come to sell those goods that you've purchased. So the entries that we can see here from the profit and loss perspective is you've got the sale of £150. Because you've sold the £100 of stock, you need to bring that off the balance sheet and into the profit and loss account. So you've got a cost of £100 against that 150, giving you a profit of £50. And on the balance sheet side of things, as I said, what has changed is you've now got this debtor of £180 for the £150 plus VAT of £30. You increase the VAT payable by the £30 and you reduce the stock held of £100. So you can see that on the debit side of the entries, you've got a total of £280 for the cost recognised in the profit and loss account. You've got the £180 debtor for the sale, which you haven't received yet. And the credit entries are the net sale of £150, the increase in VAT payable for that output tax of 30, and the reduction of the stock of the balance sheet of £100. But as I said, what all these entries have been between the profit and loss and balance sheet, there's been no cash movement yet. This is just all, so while your profit and loss might be showing you've got a profit of £50 from this transaction, you've not received any cash yet. So there's no impact on your bank balance of cash in hand. And obviously there's potentially no guarantee that you'll receive that as well. So this just demonstrates that profit and cash can be very different. and profit shouldn't be purely relied upon as a mechanism of showing that you're doing well. Is that all clear to everyone? Anyone got any questions on that? Excellent. So then what for those transactions, you know, the money is received and the supplier is paid. So as what often happens is in terms of your day-to-day operations is you quite commonly will find yourself that you're required to pay your supplier before you receive the funding, the funds from the sale that you've made. So in this instance, we can see that the £120 for the goods has been paid, and what that does is obviously reduces the accounts payable, your creditor balance, and it reduces your bank, the cash, in terms of what you've got to spend. And then when you have sold the goods, the bank increases by the £180 and it reduces the debtor on the balance sheet of £180. And as the slide shows there, that those are your cash flow entries. So in those transactions, those are actually the two amounts that are going to hit your cash flow, and being able to model that and how the periods that that's going to come in is the important part of cash flows, is making sure that you know when that cash inflow is going to happen and when the outflow is going to happen. Okay. So in terms of building that three-way model, there are a number of different methods, and it can depend on obviously where your business or organization is at in terms of monitoring and keeping cash flows and the forecast up to date. Excel is obviously predominantly a free tool that you will all have access to whenever you buy a computer or a laptop. It's already there. So Excel is really good and better than most forecasting tools out there if you've got a really sophisticated model. What you find is if there's a lot of complexity to your cash flow and how it operates and the mechanisms and levers that you can pull on which will change it, then Excel becomes a really powerful tool. It obviously is very user intensive though. It requires a lot of bespoke model and building, and that can obviously give more increase to errors or mistakes creeping into cash flows where the formulas aren't just picking up things properly. But Excel can be really powerful in particular. If you're dealing with, even if on a simplistic, if you've got a very simple cash flow, then Excel will do the job great, just as long as you make sure that you've got checks and balances on the cash flow, just to make sure that everything is being captured and that formulas are picking up the correct amounts, and make sure there's no errors creeping into it. There are a number of forecasting tools out there. They obviously cost a little bit. Most of them tend to be on subscription services now, just the same with any sort of accounting package. Most stuff moved away from the annual fee or the one-off purchase cost. They all tend to have a subscription-based mechanism now, just to make sure that you can obviously come in and out whenever it suits you, but also it helps to provide with ongoing support costs for the product. There are a number of tools out there. I mean, I use a number in my sort of day-to-day work that interact with other accounts packages like Fluidly. There's one called Cashflow. They offer different levels of experience for based on your knowledge and understanding of how it works. Some of them are very simplistic and very intuitive. Others take a bit more time and effort to get to understand and know So when it comes to looking at how you're going to, prepare your cash flow, how you're going to monitor it going forward, how often you're going to change and play about with it will kind of depend on the type of model and the system that you want to use. And obviously it's important that if you've got any concerns about what's right for you, that you have a chat with your accountant and they'll be able to advise and help find the best package to meet your needs going forward. And lastly, and this is where forecasting tools that exist out there do have their advantages over Excel, although Excel can do this as well, is integration with your accounts package. So obviously some of you are saying that you're using Xero, so Xero does have obviously some basic cash flow management within it. You can set up dashboards which look at what your cash flow might look like in the near future based on predicted incomes and spending, what that will look like. But also a lot of the forecasting tools will allow you to directly export your information into a tool which will allow just a bit more sophistication in terms of, rather than just a headline, chart or graph showing what the cash flow will look like, is actually getting into the real detail and allowing you within that tool to look at scenarios, flexing, to make sure that obviously your cash flow is quite robust and provide obviously good detail in terms of the sustainability and viability of the business going forward. So there's a pros and cons to each method in terms of how you might want to manage your cash flow and monitoring on an ongoing basis. It's just important to evaluate what's going to work best for yourself and obviously any other stakeholders that are going to see that cash flow, what's going to work out best. What I'm going to do now is take a quick look at a three-way model in action. And this was for a client of mine. They were in the care home industry and they were in the process of, they just received funding for building like a new care home because they were looking at expanding. They had one and they were looking at building out another. So what I'll do is I'll walk you through the what's happening here, and then after that I think that will be a good point for a little break so everyone can just obviously they can look at this in a little bit more detail while they grab a cup of tea or coffee, and then just digest obviously what we've gone through so far, and then we can potentially pick up any questions that you might have. So for this business, what we've got here is the cash flow statement. So this is purely just looking at the period that they had for that year, where they had projected forward to look at what their year was going to look like in terms of sales made, and also capturing obviously significant one-off transactions that were taking place. So at the top line, you can see their sales. So for each month, they were projecting revenue for the year, and you can see it's incrementing month on month. As for the care home, what was happening is more and more residents were coming into the business. They were getting more up to occupancy, and this model was monitored. One of the key assumptions on this was looking at the occupancy rate on a month by month basis and being able to justify why it is what it is. Next, you can see on it, they received a loan of 5.8 million for obviously the construction of the new care home. Obviously, it's important to understand that that is a loan, so that is not revenue, so that will not obviously appear in the profit and loss account. It's an incoming funding though, so it makes its way onto the cash flow statement. And then we look at the payments and expenses that they've got to make. So you can see that associated with the day-to-day operation of the business. They've got their invoice costs, which would have covered things like food and other day-to-day costs of operating a building. So anything like heating, light, telephone, things of that nature is all being captured there. But as you can see, they received funding and they've got to finance that. So you've got your ongoing costs associated that you were paying over to the lender in terms of the capital repayments, if it's a capital loan, or interest, and it can be obviously both. So depending on the loan, it could be both capital and interest, or interest only normally, and that's what this value is. This is the amount the business had to repay each month to the lender for the borrowing. And then we could just quickly going down the other areas, you can see that they had an overdraft facility, and you can see over the period that is decreasing as they come out of an overdrawn position, because of obviously partly to do with the funding that they received, but also the revenue line is tracking up, so they're generating more day-to-day cash, which they're able to use for the ongoing business, which means they're less reliant on a short-term overdraft facility. So the costs associated with that are decreasing. As I said, you've got the capital payments there at the top, and then you can see the interest element as well. Then you've got the wages, and again, you can see the costs for the wages are ramping up as the year goes on, and that's obviously because you can see there's a direct correlation there between the number of residents that are in the care home and the amount of staff that you need to obviously provide the care and service for those residents. So you can see that there's a direct correlation there. And in cash flow models, what you will often see is that revenue in particular is a key metric, and you can then model costs against it. So things will be a certain percentage of sales if you've got good predictability in terms of, for example, or staff costs there. So you know that you might need X number of employees to cover, Y number of residents. So it's a model that you can quite easily predict. So those should tie in quite closely together. And then down in the first month that you can see there, what you have is for the 5.8 million that they received, they've spent all of that and a tiny bit more. So the total costs there are coming to 5.85 million. So they've had a little bit of cash or short-term funding that they've had, which have been able to cover that spend. So what you see in month one is total revenue of just under 5.85 million, but total payments have been 5.92. So in that month, they've had a net outflow of cash of 72,000. And you can see from their opening balance position plus the net outflow that you can see there gives them a closing bank position of just over 340,000 as an overdraft. But what you see going forward, if you look month on month, is as the business ramped up, they're coming out of the position on a month by month where they're just the money's just continued to outflow, and they're starting to generate cash inflows to reduce their overdrawn position. So what we're seeing is over time that they're getting obviously into a healthier position, and they're no longer at a point where they're continuously pushing money out of the business. And when you're starting to build your cash flows, for any interested parties, it's the points where you're actually spending more money in a month over when you're getting it is actually really important to know, because that's where you might suddenly hit a pinch point. And we'll see that when we come on to the balance sheet and cash position as well. But you can see they're still in an overdraft position, but they're things are looking better going forward. And here we have the profit and loss account. So this is obviously looking at recognising the income and revenue and expenditure in the period to which it relates. But what you'll see, obviously, if we just focus purely on the sales figure, is obviously revenue and cash coming in are very different. And if we just focus on month one to begin with, so we can see there that they had sales of just under £100,000 for the period, and that's obviously based on number of residents and the period of time in which they were in the care home. But actually, in terms of what they received in that period, was only 49,000. So you can see there that they effectively only received half of the cash that was relating to that period in effect. And that 49,000 could also have covered parts of the previous periods as well that are just not on this model that we're seeing. So there's a significant difference between what gets reported as profit and what hits the cash flow. So looking at the total for the year, you can see there that the total revenue for sales was projected to be 1.97 million, but in terms of the cash receipts that they were anticipating to receive for that period, it was only going to be about 1.85 million. So 130,000 of the revenue that they were entitled to, they hadn't received in the period, and it was going to anticipated that be received in the future. And as I said, if we look at the overall profitability here, you can see that it was forecast that they were going to receive in total make a profit of 232,000. But in terms of their cash flow, where they've gone from has gone from they had an opening position of 270,000, and they were projecting to end up at 72,000. So their cash flows improved by about just under 200,000 compared to that 230,000 of profitability that they were expecting. And then finally, if we come to the balance sheet, what you have here is just obviously looking at your assets and liabilities. So in our assets, we've got the 6.8 million for the purchase of the new care home. Within debtors, what you are seeing is the debtors control account, and that is showing obviously the amounts receivable in relation to the care home residents, and that amount is growing as the number of residents increase. And what this figure is obviously effectively the end product and the effect of the interaction between the profit and loss account and the cash coming in. So, because what's happening is when you earn the right to the income, you recognise it as sales and on to the aged debtors book, the aged receivables, and as the cash comes in, it's reducing down that balance. So the balance sheet effectively falls out of the way the cash flow and the profit and loss interact with each other based on obviously any starting balances that you have for each of these accounts. And then we've also got the bank account, which we can see is sorry, that was a mistake. Yeah, the bank account is obviously decreasing over time. Creditors, your age payables are staying roughly the same, but what's happening is that the overall sort of working capital between debtors and creditors, we can see that the position is changing a little bit. It's getting steadily a bit better. There's the ratio between debtors and liabilities is getting a bit better, which is good for working capital, and the loan borrowing is coming down bit by bit. And what we can see from this business as it was at the time is that they were in a net liability position of 156,000, but due to the profitability, they're getting to a period where they get out of that into a net asset position. But this is how a three-way forecast looks like in terms of their interactions, but it's also really important. So a cash flow on itself is really good to understand and know and make sure that everyone understands how it works so that they can see from a cash perspective how things are performing. But in terms of as you grow and you're looking at lenders or support, they will want to see a good three-way forecast that has a reliable model showing what the future will look like. And that this three-way forecast will be based upon assumptions and recognition. And that's what we're going to be looking to cover in the next part after this little break. So hopefully that's been informative for you. As I said, I think today now would be a good time for just a 5-10 minute break just to get a tea or a coffee and then come back and take any questions that you might have before we move on to the next session.